There's a woman named Rachel. She's 34, a project manager outside of Denver, and she just closed on a $480,000 home. She posts the keys on Instagram. She talks about building equity. She tells her parents she finally feels like an adult. She is bleeding money, and she doesn't know it yet. Then there's her coworker, Marcus. Same age, same salary, $87,000 a year. He rents a 2-bedroom apartment for $1,850 a month. His family thinks he's wasting his money. His landlord thinks he's fine with that. His brokerage account thinks he's a genius. Both of these people are making choices about housing in the same city in the same year. And the gap between what they believe about those choices and what the numbers actually say, that gap is what this video is about. If you're someone who has been told your whole life that renting is throwing money away, subscribe and like this video. It might genuinely change how you think about one of the biggest financial decisions of your life. Here's the story most of us grew up hearing. Owning a home is wealth, renting is waste, your parents said it, your bank's website says it, every real estate agent who has ever handed you a business card says it, and for most of the 20th century it was basically true, but 2026 is not your parents' housing market. The real problem isn't that homeownership is always a bad idea. The real problem is that most buyers are making a decision based on a feeling, stability, status, adulthood, while the math underneath that decision has quietly shifted against them. They are buying an emotion at a price they haven't fully calculated. Think of it like buying a car you can see on the lot. The sticker says $42,000. What the sticker doesn't say is that you'll pay $8,000 in taxes, $3,000 in insurance over 2 years, $1,200 in maintenance, and $600 in registration. The real number is closer to $55,000, and nobody hands you that sheet when you walk in. Homeownership in 2026 works exactly the same way. Except the gap between the sticker and the real number is much, much larger. Let's go back to Rachel in Denver. She bought a $480,000 home with 10% down. That's $48,000 out of her savings on day one. Her mortgage payment on the remaining $432,000 at today's rate of around 6.7% comes out to roughly $2,800 a month. She budgeted for that. She was proud of herself for budgeting for that. What she did not fully budget for is everything else. Property taxes on a $480,000 home in Colorado run about 1.1% annually. That's $5,280 a year, or $440 a month, added to her payment. Homeowners insurance, which has jumped 48% nationally since 2020 according to a Zillow and Thumbtack analysis, runs her about $2,000 a year. That's another $167 a month. And then there's maintenance. The rule of thumb is 1% of the home's value per year, which for Rachel means roughly $400 a month going into a reserve fund for when the furnace dies, the roof needs patching, or the water heater decides to quit in February. Add it up. Rachel's real monthly housing cost is closer to $3,800. Not $2,800. That $1,000 difference is bigger than a car payment. It is, in fact, almost exactly what Rachel used to put into her 401k every month. According to a 2025 Zillow and Thumbtack report, the average American homeowner pays nearly $16,000 a year in hidden costs, maintenance, insurance, and property taxes alone, on top of their mortgage. That's $1,333 a month that never appears in the mortgage calculator most buyers use when they're dreaming over Zillow listings at midnight. Now look at Marcus. He pays $1,850 a month in rent. Yes, that number goes to a landlord. Yes, he builds no equity in that apartment. But here's what Marcus also does. He keeps his $48,000 down payment invested in a diversified index fund. At a conservative 7% average annual return, that $48,000 becomes roughly $94,000 in 10 years, without adding another dollar. He maxes out his Roth IRA every year. He doesn't lose a weekend regrouting a bathroom. And his rent? According to Realtor.com data, median rents have actually declined for 26 consecutive months as of late 2025. The rental market in 2026 is softening. Marcus is negotiating. Rachel's mortgage is fixed, but her taxes, insurance, and maintenance bills are not. This is the invisible line most people never see. The line between the housing cost you know about and the housing cost you will actually live with. Here is where it gets harder to hear. The single most dangerous belief in housing is not that renting is bad. It's this: I have to buy now before it gets worse. That sentence has driven millions of people into homes they couldn't actually afford. It creates urgency where patience would serve better, and in 2026, it is still circulating, even as the data tells a more complicated story. Home prices in more than 2/3 of U.S. counties rose faster than rents in 2025, according to Adams data. That means buyers are paying more for the asset even as the carrying costs climb. The break-even point, the moment when buying finally becomes financially superior to renting, typically sits at 5 to 7 years in most markets. If you move before then, the transaction costs alone eat the equity you built. Think about what 5 to 7 years actually means. It means your job can't change cities. It means your family situation has to stay roughly the same. It means you are not just buying a house. You are buying a 5 to 7 year commitment to a place with a $16,000 a year overhead attached. Rachel knows this intellectually, but she didn't feel it when she was standing in that kitchen with the farmhouse sink and the open shelving. Nobody does. That's not a character flaw. That's just how decisions get made when emotion and identity are wrapped up in a financial product. The question isn't whether owning is ever smart. It absolutely can be. The question is whether it's smart for you, in this market, at this moment in your life, and most people answer that question before they do the math. So what do you actually do with this? The first thing is to run what I'd call the full cost number before you run the mortgage number. Take the home price you're considering. Add 1% per year for maintenance, 1.1% for property taxes if you're buying somewhere near the national average, and current insurance premiums for your specific region. Then add that total to your mortgage payment. If that number, the real number, leaves you less than $500 a month of breathing room after your other bills, you are not in a financial position to buy that home. You're in a position to feel good about buying that home. Those are different things. The second thing is to take the down payment you've saved and genuinely model what happens if you invested instead. Not to argue yourself out of buying forever, but to see the real trade-off clearly. A $60,000 down payment invested over 10 years at 7% is not nothing. It's the kind of money that quietly changes your retirement math. I've run my own numbers on this more than once. The point isn't that investing always beats buying. The point is that throwing money away is not a real analysis. It's a slogan. Third, and this one matters especially if you are in your early 30s, give yourself honest credit for the value of flexibility. The modern workforce is not a 30-year stint at one employer in one city. Remote work has restructured where people can actually live. Careers accelerate through moves. Relationships change geography. A mortgage is a chain, and sometimes a chain is exactly what you want, but know what you're signing before you sign it. Rachel posted those house keys on Instagram 9 months ago. Last month, she had to replace her HVAC unit. $4,000, right out of the emergency fund she was still rebuilding after the down payment. She's not devastated, she's not ruined, but she is no longer posting about equity. Marcus is still in his apartment. He got a promotion, negotiated his rent down $75 a month at renewal, and put the difference into his Roth IRA. He's not winning because he rents. He's winning because he made a deliberate decision and then worked the math in his favor. Neither of them made a permanent choice. Rachel can sell in a few years. Marcus can buy when the numbers work for him. The goal was never to pick a side in a culture war between renters and owners. The goal is to see the real cost before you commit to it. In 2026, the housing market is not punishing buyers and rewarding renters across the board. It's punishing people who make decisions based on identity rather than information. The farmhouse sink is not a retirement plan. And the decision you make about where to live should be the same kind of decision you'd make about anything else worth $400,000. Calm, deliberate, and with all the numbers on the table. If this video changed how you're thinking about the rent versus buy question, leave a comment below. Tell me where you are in the decision, renting, buying, or somewhere in the middle. And if you found this useful, a like helps more than you'd think.